All right, let's go ahead and get started. So once again, just want to welcome everybody to this evening's event. Tonight we're going to be exploring how to use your IRA and 401k to invest in real estate. I'm really excited to be hosting this event, and clearly I'm not alone. We have a huge group here this evening. We're really glad you guys are all here. Lots and lots of exciting stuff to cover tonight. Just real quick housekeeping item, just to be cognizant of time, we are actually not going to be answering questions live on the forum tonight, but feel free to please still type your questions in the chat box. That's going to help Dimitri and I respond to them later this week. So that is helpful if you still submit your questions, but we will follow up later this week with you directly to answer anything case specific. So with that, let's go ahead and dive on in. Sorry. One sec, guys. Oh, all right. Well, I was trying to find my little, here we go. Meet the advisor tab. All right. Sorry about that, guys. Tech difficulties. I'm slightly tech challenged. For those of you I haven't met, I know a lot of you that are here tonight. So, but for all of you I haven't had the opportunity to connect with, my name's Rachel. Clearly, technology is not my gift in life. But I do love real estate. I'm a realtor and advisor here on the team at Marshall Reddick. And a quick little background on me, I grew up just outside of Seattle and then moved down to sunny Southern California for college. I was ready to ditch the umbrella and go somewhere closer to the beach. So I have my bachelor's degree from Vanguard University, and I'm a licensed realtor in both the states of California and Texas. I moved out to the Woodlands, which is North Houston, last June. So I've been here just over a year and really loving that so far. So my journey personally with Marshall Reddick actually started over 10 years ago at this point as a client when my husband and I bought our first investment property with the help of an advisor with Marshall Reddick. So fast forward a decade and a few properties later, I'm here tonight. And I'm definitely a true believer in what Marshall Reddick can do to help our clients achieve. I've seen it firsthand, not only for myself, but obviously for countless others as well. All right, so as far as our services here in-house at Marshall Reddick, we really are a one-stop shop for any real estate needs that any of our clients might have. So we are a brokerage. We help our clients buy and sell residential real estate. So some of those clients are purchasing their primary residences. I'm helping actually quite a few clients purchasing those out here in Texas at this time. Some of those are shopping for in some of our markets, vacation homes, a lot of people doing that in coastal Orange County or Florida, things like that. Others come to us for a one-stop shop investment property services. So that's a lot of our clients find us that way as well. We're also a private money lender. So we help our clients by providing private money loans to help fund a variety of programs. On the flip side of that coin, we have individual investors that fund each and every one of those loans. So there's people investing by extending the money and people borrowing as well. So we also have the Marshall Reddick Fund, which is available to accredited investors. And the fund is an awesome passive income option for those who are qualified to participate. You do need to be accredited to do so. I'd be happy to discuss that with anyone who has any further questions. And lastly, we have incredible in-house property management services in all of our primary markets. So if you're investing in real estate long distance, which most of our investors are doing, so I occasionally have people that are local that invest locally, but for the most part, a lot of our investors are long distance. Your property manager is really going to make or break your success with your property. So I can definitely speak to the incredible services of our property management team, as I'm a client in a couple of our different markets with Marshall Reddick, and their services are top notch. So as you can see, our team, like obviously myself and most of my other partners on the team, we really do believe in the services Marshall Reddick offers. Most of us are involved in multiple, if not every facet of Marshall Reddick as partners as well. So I can speak from experience how much it's done for me. All right. So our market. So we have teams in 16 major metro markets across 8 different states. Of those markets, our primary Marshall Reddick markets are located throughout California, in Central Texas, Southwest Florida, Tennessee, and Kentucky as well. And a lot of times my clients come to me and they're like, Rachel, how do you guys choose the criteria of where to invest? So that's an excellent question. These are the 7 different facets we really review and have focused on in all of our markets throughout the year. So the job market, that's very important, making sure there's a stable selection of multiple jobs to choose from. Vacancy rates with properties, we want to make sure we see those numbers low historically. Economic diversity, that is extremely important. You don't want any area to be too dependent on one employer. So that is how we've handpicked our primary markets. They have flourishing economic diversity as well. Housing affordability, that's huge. You want to make sure that your tenants can afford to pay their rent based on geographic salaries and statistical housing costs. So yes, housing affordability is very important. I think honestly, personally, item number 5 is arguably the most important of where you choose to invest. Is it a landlord-friendly state? With the exception of California, all of our out-of-state, as you could say, out-of-state markets, so, Texas, Tennessee, Kentucky, all of Florida, all those are very, 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 very landlord-friendly states. Laws are written in favor of landlords. If we do an incredible job vetting the tenants before we place them, but God forbid you ever did have any issues with your tenants, you are in a state where the laws are written in your favor. So that's very important. Strong education, I think that speaks for itself. And then reliable property management. This is crucial. I have invested in markets that were our secondary markets, and I had to use a third-party vendor that was not Marshall Reddick for property manager, and I can speak, confidently and with experience of multiple other vendors. Marshall Reddick is incredible what they do. They are top notch with the property management, so definitely recommend that as well. Okay, so with that, it's my pleasure to introduce you to tonight's keynote speaker, Dimitri. Fun fact about Dimitri, he actually started or worked as an advisor at Marshall Reddick many, many years ago, and there's many clients that worked with him back in the day that have continued to use his services with his firm, Sense Financial. So he's a great guy, a wealth of information, and I think you guys are going to get a lot out of tonight's presentation. So with that, it's my pleasure to turn it over to Dimitri.
Thank you so much, Rachel, and thank you everyone for joining us. I'm always excited speaking about this topic, but just a quick disclaimer that my information that I'm presenting is for informational purposes only. Don't interpret that as a legal, tax, or investment advice. But I'm happy to discuss with you about your each specific situation. And just a couple of words on reflecting on what Rachel said. I'm also a client of Marshall Reddick. I invested on real estate that they assisted me purchase. I invested in multiple notes. I invested in a fund, and they're great team player helping me grow my wealth. And I'm just excited to partner with them to help our mutual clients. Our goal as a company to help you obtain control and protect your retirement accounts. Proverbs 21:5 says, good planning and hard work leads to prosperity. And I know that all of you guys working hard for your money, but we want to help you make sure that your money is also working hard for you. And my specific focus is on ensuring that that money in your retirement accounts are working hard for you, because for most people who have retirement accounts, their retirement accounts in so to speak IRA prison, because they're locked up and with very limited investment options. And to illustrate that, I wanted to show you an example. of Jason. Jason is one of our very first clients, actually, all-time client. He had a couple of different accounts before coming to us. He was losing money in investing in the stock market, was actually watching his statements, balances going down every single month. He was concerned about just government uncontrolled borrowing and potentially even coming after individual retirement accounts. So he was looking for alternatives. He found Sense Financial online. He reached out to us, and what we did for him is this a little bit of a makeover, so to speak. So take a look. After we established a self-directed solo 401k plan for him, he was able to purchase a rental property. He invested in his brother's business, and he also invested in a real estate note. He actually became a bank, or his 401k became a bank. And he's collecting about $1,000 a month in cash flow on his funds. And rather than looking at his or comparing to the situation before where his balances were going down, his balances actually going up every single month because he's getting a cash flow. And the assets that he owns in his 401k actually increased in value. That rental house that you can see, they are probably more than doubled in value since he became a client and since he purchased that in his 401k, probably tripled in value by now, given the market where it is. So, and that's what you can do as well. Now let's take a look at the options. So there's really three options when it comes to self-directing your retirement account. There is a self-directed IRA that is held by the custodian. There is a checkbook IRA, and there is a self-directed solo 401k, which is also known as the ultimate retirement plan. And I'll explain why that name. You'll see that yourself. But let's take a look at each one of these options. But before I do that, let's take a look at just a quick comparison of conventional retirement accounts. Like I said, if you have an IRA or a 401k with just a conventional custodian, you're in a prison where you can only invest in stocks, bonds, and mutual funds. But my goal for those of you who want to get out of that prison is to unlock the investment options. This is just an example of when I used to work for Marshall Reddick, by the way, 15 years ago or so, I had a 401k, and we actually had a representative who come up to us and meet with all the participants in the 401k, giving us a sheet similar to this one with just maybe a dozen investment options. And they're all mutual funds. Those are the only options that were available in that 401k. Now, if you have an IRA, you have more choices of mutual funds, but it's still limited to one investment class. Well, when you switch to self-directed, so what you see on the right hand side here is that the options that will be available to you if you go the self-directed route. You can invest in real estate, residential and commercial. You can invest in tax liens. You can invest in cryptocurrency, although my personal opinion of the cryptocurrency is it's more of a speculation than investment. But nonetheless, you can do that. You can invest in mortgage notes, something that Marshall Reddick offers. It's a great way, I believe, to grow your retirement wealth. That's actually my preferred way to invest my retirement dollars, is being a private lender. You can invest in private businesses. I had the opportunity to do that as well several years ago. You can invest in real estate internationally. You're not just limited to buying investment properties or commercial real estate in California. You can do that outside of the country as well. I have clients who invested in Canada, in South America, in Japan, in India, and in Europe. So you can do all of that. And also you can the same way you can invest in stocks and mutual funds. So there is a sometimes people actually mistakenly think that self-directed IRA is the same thing as a real estate IRA, or they think you can only invest in real estate. No, real estate is probably the most common investment, but it's not obviously the only investment that is available. In fact, IRS actually doesn't have a list of approved investments. So if you hear somebody advertising that this is a investment approved by the IRS for a retirement account, that's false information. Run away from that, because IRS does not approve investments. They do have a list of limitations, and we'll go over that. I'll explain those. But then they don't approve investments. So what is a self-directed IRA? It's a tax-deferred trust account that is held with the IRS-approved custodian. So note this: if you have an IRA, you must have a custodian to have an IRA. But the custodian for a self-directed IRA is they don't offer investments. They offer a service of holding an IRA, and you pick the investments in line with within those parameters that IRS allows. And majority of people not even aware that they exist, but they've been around since 1974. And they benefit people like you and myself to save or to put money away for the retirement under Internal Revenue Code Section 408. So let's take a look how it works. Step number one, you have to open an account with the IRS approved custodian. Step number two, you will do the transfer of funds from your existing IRA, or if you have a 401k or 403b from the previous employer, you can move those funds as well. So you fund a newly established self-directed IRA account, and then as the account holder, you actually direct the custodian. So you tell the custodian what they want to do, but you must go through the custodian. So custodian is essentially a middleman between you and your IRA. So they hold the IRA, they hold all the assets of an IRA, and you have to tell them what to do. And you can direct them to buy a piece of real estate, invest in a mortgage note, and so on. Now, all of the income from those investments must go back into an IRA, and all of the expenses related to the investments that IRA holds must be paid from an IRA. So for example, if you own a rental property inside of your IRA, property taxes, insurance, and all the maintenance repairs must be paid from an IRA. You cannot pay any of those expenses with the personal funds. So obviously a great way to get out of just the conventional investments, but the disadvantage is that custodian is in there to make money, and you have to go through the custodian for each transaction, which is inconvenience, and also each transaction cost you something. So when you make the investment, when you sell the investment, when you have to pay investment related expense, you have to go through the custodian and pay the fee. And those fees add up as your account grows and you acquire more and more investments. But I think the main reason why people dislike this option is because of the inconvenience going through the middleman. That's where the checkbook IRA comes in. So what is a checkbook IRA? Essentially, it's a special purpose LLC that your IRA owns. So, it's created for single purpose to be owned by the IRA. It does require IRS compliance setup and operating agreement, because remember, your IRA owns the LLC, but this structure allows you to bypass the custodian when making investment and any investment transactions. So let's take a look how that works. Similar to the custodial IRA, you do need to open a custodial account, because again, if you have an IRA, you must have a custodian. Then you, the same way, you will fund it with the transfer or rollover from your existing retirement account. And for an IRA, typically, if you want to go the self-directed route, in most cases, you will want to bring something from your existing retirement account, because the contribution limit for an IRA is only $6,000 for in a year. So it's pretty small, and there is not much you can do with $6,000 as far as alternative investments. Now, then the special purpose single member LLC is formed. You become the manager of that LLC. So you're the account holder, but you're also the manager of the LLC. And as a manager of the LLC, you control the LLC. So IRA makes a single investment into LLC. So essentially IRA buys the LLC. LLC is essentially the investment inside of an IRA. And then all the subsequent investments that are made inside of the LLC you control. So as the manager of the LLC, you will open a checking account, and IRA will buy the units of the LLC. So essentially invest into that LLC, 100% of the units. And then as the manager of the LLC, then you decide where you want to invest, and you actually execute those transactions. You will sign the purchase agreement to buy that rental property. If you're investing in a note, you will sign a promissory note or a deed of trust, whatever the paperwork is required for the investment. You no longer have to go through the custodian. You're actually able to bypass the custodian. Now, all the income must go back into the LLC checking account. It doesn't go back to the custodian because LLC owns the investment, and all of the investment income goes back to the LLC checking account. And all of the expenses are paid from the LLC checking account. So see the difference? You don't have to go through the custodian any longer. You're able to bypass the custodian. Custodian is still there. You're paying them small nominal fee to hold your IRA, but all the investments are made inside of an LLC. So two major advantages to this structure is that it minimizes your overall cost, and it actually streamlines the transactions because you don't have to deal with the custodian, you don't have to deal with the red tape that comes with having a custodian, and it's very convenient. And last but not least is self-directed solo 401k. So what is it? It's set up under Internal Revenue Code Section 401, and it is defined as retirement savings trust. But solo 401k is not for everyone. It's designed for those people who are either self-employed or own a small business without full-time employees. It's not a new type of plan. They have been around, but actually they've been made very popular in year 2002, about 20 years ago, when there's been some changes in the tax law that made all the benefits possible. So this law changed, made some features that I'm about to discuss in the next few slides with you. So let's talk about eligibility. As I mentioned, it's not for everyone. So who is it for? Well, you have to meet two criteria. Number one, you have to have the presence of self-employment activity. It has to be legitimate activity and can be in any way, shape, or form. Okay, so that's number one. And then number two, you have to have the presence of, you have to have you cannot have any full-time employees working for you. It's actually, again, with the recent changes in the tax law 2 years ago, those numbers change. So normally it's 1,000 hours for part-time employees, but if you have part-time, long-term part-time employees working for you longer than 3 years, then that number drops to 500 hours. So essentially, again, small business owners. Now, you may be looking at this and saying, well, I'm not self-employed, I don't qualify for it. And you may not be eligible right now, but it's not that difficult to start a self-employment activity or a side business. There are numerous benefits to that you can create extra income that will enable you to actually invest that income so you can achieve your financial goals sooner, and that will make you eligible for solo 401k. And also with having a business, there are many tax benefits that you can enjoy. So essentially, if you own a business with full-time employees, that will disqualify you. Otherwise, it's possible to have a solo 401k. You may be eligible now, or you may need to do few changes to make that happen. So let's take a look how the solo 401k works. Well, number one, you have to have a sponsor of the plan. And that is, again, having that business in place or a self-employment activity. It has to be legitimate business or legitimate self-employment activity. One misunderstanding that actually I run into often is that people think, well, I'm a real estate investor, that's my business, I qualify, they think. Well, and I ask, what is your business? Well, I do own 3 rental properties, that's my real estate business. Well, if you own rental properties and you generate rental income as your quote-unquote business income, the rental income in its nature is considered passive income. So that's not taxed as a business income. It's not subject to self-employment taxes. It's actually reported on a Schedule C, on a Schedule E rather than on a Schedule C. So just owning a rental property will not qualify you. You have to have legitimate self-employment income. Now there are ways to actually go work around that. If you own a portfolio of real estate and you manage them yourself, you can set up a property management business. That's a possibility, but you'll have to convert a portion of your rental income into like a management fee, which is then will be considered self-employment income. So that's a possibility. Happy to discuss that with you, and you probably want to bring your CPA into the conversation as well. But once you have that plan sponsor, by the way, you don't have to have a legal entity to do that. You don't have to have a corporation or LLC. If you have one, great. If you don't, if you just let's say a real estate agent. Many of my clients are actually real estate agents. So if you're a real estate agent and if you just whether you're doing it part-time or full-time, you're eligible. And if you just work using your own social security number without any entity set up, then you are considered sole proprietor, and that's IRS legal recognized business type that can adopt a 401k. Next, the sponsor adopts the plan, and a plan and trust are created. Now, a trust here is used to hold the plan assets. So the solo 401k trust is the legal entity. It will have its own unique name and its own tax ID number that IRS will assign, and IRS will know that this is a tax-exempt entity. You become designated plan trustee and the plan administrator. As plan trustee, your role is to control the trust. And you're the only one who controls it. No one else has access to your trust. We don't have access to your trust and your assets and your accounts. You're the only one. Possibly, if it's a husband and wife, both can be trustees, both can have equal control over the trust. So there is typically 1 or 2 trustees in the solo 401k plan. And as a trustee, then you are able to open a business checking account at any bank or financial institution such as credit union or brokerage. And then in a similar manner as a checkbook IRA, you can buy investments directly in the trust using trust name as a title holder. And as a trustee, you will sign all the documents. You'll sign the purchase agreement. You will sign all the investment documents. And all of the income is going back to the trust bank account. All of the expenses are paid from the trust bank account. Like again, if you own a rental property, you will pay property taxes, insurance, and all the repairs from the bank account. There is no middleman. There is no custodian in the picture, and there is no LLC that is needed. And because one of the downsides of having the LLC, some states are it's quite expensive to have the LLC. Like California is the highest cost for the LLC. A trust is not set up in the state. 401k is established on the federal level, so the trust is not registered in California. There is no cost from the state. It's very, very cost effective and very convenient because it gives you all the control. Now, so let's take a look at the benefits of the solo 401k. Why is it actually called the ultimate retirement plan? Because contribution limits to a solo 401k for this year is at $61,000. Now compare that to an IRA at $6,000. So it's 10 times higher. And if you're over age 50, then you can actually contribute a catch-up contribution, which is additional $6,500. So that makes a total of 67.5. A tremendous opportunity. I mean, just think about this. If you're in a business together with your spouse, and you have your business and you're making good income, and if you're able to maximize the contributions, and that's over $120,000 potentially that you can shelter from taxes, and you can drop your taxable income by that much. I mean, think about what is it going to do to your bottom line. You're going to be able to drop probably to a lower tax bracket, maybe two even, by dropping your taxable income that much. So you're going to be paying on a much smaller amount in a smaller bracket. So the tax savings can be pretty significant, 40,000 potentially in a single year. So it's huge. So that in and of itself is just a worth to set up the solo 401k, just the tax savings. Also, there is a loan feature which allows you to take a loan from your 401k up to 50,000 or 50% of the balance, whichever is less. You can use this loan for any purpose, any reason. And please note that you're not able to take a loan from an IRA. That's not possible, only from a 401k. It's not something that I normally encourage or even recommend, but it is a nice feature to have. Should you have a need for cash, you don't have to cash in your retirement account, pay the taxes and early distribution penalties. You can just take a loan from the 401k, repay it back so there is no tax consequences, no penalties. There is interest. You have to pay interest on the loan, but essentially you're paying back to your own 401k. The interest goes directly to the 401k. Also, with the solo 401k, all of the plans that we established, they do come with the ROT provision, allowing you to make ROT contributions. So as you know, ROT contributions, they've already been taxed, so it's after-tax contributions. And you can contribute up to $27,000. That's including the catch-up. So compare that with $7,000 for a Roth IRA. And Roth IRA is income dependent. If you're over a certain threshold, you're not able to qualify to contribute to Roth IRA. But with the solo 401k, Roth contributions are not dependent on your income. You can contribute regardless how much you make. It does give you also checkbook control, and it's very cost effective because there is no custodian, no LLC. You act as the trustee of the plan, and also you can save even more if your spouse is part of your business. Or possibly if your spouse is in a different business, but also either owns a separate business or self-employed, most likely your spouse can be also made a participant in the plan. So you essentially double the benefits with your spouse without incurring any additional cost. And last but not least, it is exempt from UDFI, which stands for Unrelated Debt Finance Income. When you buy investment property in an IRA and you use leverage, you use a loan to buy the property, a portion of the income that is coming from the finance portion of the property will be subject to taxation because that income is taxable. In an IRA, 401k is not subject to this taxation. So just another reason to use 401k to invest in real estate and use leverage. The self-directed IRA or 401k allows you to truly have diversification. here a credit goes to my daughter. She was maybe 5 years old at the time when she drew this, but she the man holding a basket, and the bottom fell off, all the eggs are broken, and wife is just wondering what happened. I thought that our investments were diversified. Well, if all of your eggs in one basket, they're not diversified. So if all of your investments of your IRA or 401k only in mutual funds, they're not diversified because it's just one asset class. To achieve true diversification, you must have self-directed IRA, which will enable you to invest in different classes, asset classes. Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on this earth. It's been written thousands of years ago, but it's so true even in now our days. You don't have to go back to see the application of that. Just earlier this year, we've seen the significant drop in the market. Also, when the pandemic hit in 2020, I'm talking to people constantly that even just recently sharing with me about the effect of their or the result, how the market affected their retirement accounts just in the first few months of this year. Some saying they're down 20-30%, and my response to them, well, my portfolio is actually growing because I have different asset classes. As far as my retirement accounts, it's mainly in real estate notes, which they keep paying. I get interest payments on my notes every single month. So there is no, the market doesn't have any effect on my portfolio. Yes, it's possible that some of the payments might be late. I have that happen once in a while, but still eventually they pay off. And the risk is very small because investment is protected by real property. So think about this. You do wanna, you don't wanna have all of your eggs in one basket. And again, just to summarize, you have unlimited virtually investment options. You can invest in precious metals, real estate, residential and commercial. You can lend money and on and on and on. Well, let's spend a few minutes to talk about the limitations. The prohibited transactions. The Internal Revenue Code section 4975 says that you cannot use your IRA to invest in collectibles, to invest in life insurance, and to invest in an S corporation. And the reason for the S corporation is that you have to be actually only a physical person can be a shareholder of an S corporation. Now, people sometimes misinterpret this slide and they say, well, if I have a S corporation, that means I cannot have a solo 401k. No, that's not what I'm saying here. If you have a S corporation, your S corporation can establish a solo 401k, assuming there is no full-time employees there, but your 401k cannot invest in somebody else's S corporation. That's what I'm saying here. Also, Internal Revenue Code section 4975 says that there is such people as a disqualified person, and disqualified person is defined as the owner of the IRA or 401k, the spouse of the owner, your parents, grandparents, your kids, grandkids, and their spouses, any investment advisors, any fiduciaries who provide services to the plan, and also any business entity in which any of the disqualified persons own 50% or greater interest. And most prohibited transactions take place. Again, that's in addition to those prohibited investment, which is collectibles, life insurance, and S corporation. Also, if any of the disqualified person engage in a transaction with the 401k, prohibited transaction occurs, which will disqualify your retirement plan. And And this language I pulled from the IRS, directly from the IRS website. It says that any sale, exchange, or leasing of any property between a plan and a disqualified person. So example to this is sometimes people ask me, well, I do own a property, I do own a rental. Can I put that in my 401k? Well, you can just put that in a 401k. If you sell it to your 401k, that will be prohibited because that will be a transaction between disqualified person and a qualified plan. That is not allowed. Lending money or extending of credit between a plan and disqualified person. That's why the loan must be non-recourse. When you buy in a property inside of an IRA or a 401k, you cannot guarantee that loan. The loan must be non-recourse. And Marsh Reddick actually has some great lending options as far as private lending that caters to IRA and 401k investors. You cannot provide any goods or services or facilities between a plan and disqualified person. Example of that can be a real estate agent. So if Rachel decides to set up a solo 401k plan and buy a rental property, she cannot be the agent representing that transaction because that will be considered she's providing services to the plan, and that is prohibited. Transfer to or used by or for the benefit of a disqualified person of the income or assets of the plan. Or how can that be? One example is if you own a vacation rental in your 401k, you personally cannot go and stay in that property because that's going to be for your benefit. That is not allowed. Any act by disqualified person whose fiduciary where he or she deals with the income or assets of the plan for his or her own interest. And finally, receiving any consideration for his own personal account by any disqualified person who's a fiduciary from any party dealing with the plan in connection with the transaction. And again, example of being a real estate agent and actually receiving a commission. So not only you cannot be the agent on the transaction, but if you're an agent and you're receiving a commission for that transaction, then you're violating two prohibited transaction rules. Hopefully that makes sense. Buying real estate is inside of an IRA is possible and very popular. All the income and gains must be go to the account, so they're basically sheltered from taxes. You pay taxes at a later day. Inside of a Roth IRA or 401k, it's actually tax-free. And as far as financing, again, cannot provide a personal guarantee, must be non-recourse. Property is the only security for the loan. Typically, you need 30 to 50% down. Property must produce sufficient cash flow to pay all of the expenses. Lender will want to see reserves. It will trigger UBIT in an IRA, and only few banks and lenders offer that. And finally, just a quick comparison of the three options here. All of them allow you to invest in alternative options. You do need a custodian with an IRA, but Checkbook IRA and a solo 401k offer you a checkbook control. And both of this option will eliminate the transaction fees. But you do have LLC fees depending on the state for a Checkbook IRA or IRA LLC, which is the same thing. You can take a loan only from a 401k, not an IRA. If you use leverage, you will incur UBIT, unrelated business income tax, in an IRA, whether it's custodial or a checkbook. As you can see, contribution limit is significantly higher, almost 10 times higher with solo 401k. With solo 401k, you can also have a Roth component or Roth sub-account, and solo 401k does require self-employment activity or business. I'm just out of breath. There's been a lot of information I had to cover in this limited time. I do appreciate you guys hanging in there, but you probably have some questions as you were thinking. And again, as Rachel encouraged, you're welcome to type them there in the comments, which we will be able to see and get back to you. But if you want to talk to me one-on-one, you have that ability. I do offer complimentary 15-minute consultation, and you can go directly to this link, or actually just to our website. There's another link at sensefinancial.com, and that will take you directly to my calendar. You can see the availability on my calendar in real time, and you can block that time slot that works best for you. Thank you so much. I think I'm gonna pass it back to Rachel. I believe she has a couple more slides before we conclude. Thank you again for your attention.
Thanks, Dimitri. That was super helpful. Really appreciate it. Definitely want to continue to build out my retirement accounts and expand. I have one of them, but some great options you covered tonight. So thank you again so much. All right, guys, for just a couple quick things, housekeeping items for those of you shifting gears back to Marshall Reddick that have not had a chance to go through our property rating ebook. I definitely recommend using the link below to go through that resource. It's a quick read, about 30 minutes, but super helpful if you are leaning in the direction of wanting to invest in real estate with your retirement accounts. This is probably my favorite piece of free education on the Marshall Reddick website. Some really good info. All right. So if for those of you that are not presently working with an advisor, I definitely recommend reaching out. I would love to schedule a time to chat with you. This is kind of what you can expect when you meet with us. It's at no cost to our clients. It's a entirely free service for you guys. But essentially my role, even though I am a licensed agent, if you're not buying locally with me, then a lot of what I do is in a more consultative manner. So I sit down with my clients to get to know each other. I learn why you have your goals. We set them up together, kind of discuss that. We look at the different options. There's all sorts of different ways, like Dimitri was saying, even within Marshall Reddick, you could go with the private lending tools on either side of those. You could go with investing in real estate, all sorts of different things. So when time frame, that's $1 million question, and it depends for every client I work with. It's a little bit different. So what we'll look at your big picture and set up a criteria of what you're looking for. Where, if you are going the direction of real estate, we will look at all of our different markets and determine what's the best fit. And then who, introduce you to all the key players. So obviously Dimitri is a huge part of our extended team as our preferred vendor for everything retirement account related, and he helps our clients all the time being able to shelter their assets, which is increasingly more important as the value of the dollar continues to deteriorate. It's more important than ever to utilize these tools and protect your financial legacy. So that's what you can expect from a consultation with me. So here is my info. Feel free to reach out, or if you have any questions, for those that put questions in the text box, then Dimitri and I will be following up later this week. But thank you guys again all so much for coming out. We really appreciated having you, and hope that everybody has a wonderful evening. So with that, thank you again so much. And thank you, Dimitri. I hope everybody has a wonderful night.
Thank you. Good night.
Okay, take care, guys.